Welcome to the deep dive. Today, we're doing something a little different. Instead of focusing on just one single book, we're actually pulling insights from a whole stack of sources.
Yeah, things like articles, some cutting-edge research, expert notes,
Mm-hmm.
a real mix.
Exactly. And the idea is to arm you with some of the sharpest perspectives out there. Our mission. Well, it's to really dissect the intricate dynamics of success and, well, failure too,
Hmm.
exploring how these really powerful forces play out across, markets, innovation, and leadership.
It's about unearthing those sort of hidden mechanisms.
Yeah, the things that drive breakthroughs, but also sometimes those really painful setbacks.
And what's compelling, I think, is this multidisciplinary approach we're taking.
Right.
Because when you talk about something as big as success and failure, well, you rarely get the full picture from just one field, do you?
No, absolutely not.
So we're connecting knots here between, say, high-stakes corporate strategy
And personal finance.
and even, the deep currents of human psychology. It all ties together.
We'll be sifting through all these diverse fields, really looking for those subtle but incredibly powerful patterns.
The ones that shine a light on both the big triumphs and, the significant challenges, sometimes even the catastrophic ones.
Our journey today, really, it's about cutting through all the noise
Yeah, there's a lot of it.
and delivering those aha moments. We want to give you the essential nuggets of knowledge, the things that highlight that complex interplay between, strategic choices, our own human behaviors.
And those market forces that are always shifting under our feet.
Think of it like a shortcut, maybe, to being genuinely well-informed, giving you frameworks,
Frameworks to understand how value gets created.
sometimes tragically lost,
Mm-hmm.
and then often dramatically redefined. It's
Yeah.
about seeing those threads, right?
Exactly. Seeing how seemingly separate events and decisions are actually woven together.
And what's fascinating, connecting this to the bigger picture, is how often the foundational principles are remarkably consistent.
Right. Whether you're looking at a scrappy startup
Or a volatile financial market.
or even just honing your own personal leadership style, the core ideas often echo.
So this deep dive, it's really designed to equip you with some robust frameworks for critical thinking.
Frameworks you can actually apply, immediately in a world that's just overflowing with information.
We aim to clarify, contextualize, and connect these ideas for you.
Okay, let's begin. Where shall we start?
The shifting sands of strategy and innovation.
Okay, let's dive into this first big idea. How companies don't just, create value, but actually sustain it over the long haul.
Right, because short-term wins are one thing, but lasting success is another beast entirely.
In our sources, they consistently suggest it's rarely about just doing more of the same thing.
We're just being incrementally better than the guy next door.
Exactly. There's usually a much more fundamental, sometimes kind of counterintuitive strategic choice involved.
And that's where this concept from Blue Ocean strategy really comes into play. It pushes us to think differently.
Beyond the usual battlefield, so to speak.
Precisely. Instead of just competing head-on in what they call red oceans.
Which are those existing markets, right, where everyone's fighting tooth and nail.
Yeah, bloody competition, cutthroat tactics, everyone scrapping for a shrinking piece of the pie. It's exhausting and often not that profitable.
So the alternative?
The alternative is creating blue oceans, uncontested market space.
Making competition irrelevant.
Well, irrelevant for a while at least. These aren't just small tweaks. They're about fundamentally reconfiguring a market or even creating a whole new one.
And what's really insightful, maybe even a bit surprising, is that these blue oceans, they aren't always born from some radical new technology, are they?
No, not necessarily. The source is clear on this. It's not technology innovation per se that defines them.
So if you're listening and thinking you need to invent the next iPhone, maybe not.
Maybe not. The key defining feature, as the book puts it, is value innovation.
Value innovation.
Okay. It's not about inventing something new just because it's new or pushing tech for tech's sake. It's about strategically linking that innovation directly to what buyers truly value.
They actually care about it, will pay for.
Exactly. And interestingly, this often comes from within existing core businesses, not always from some moonshot project way outside their comfort zone.
So it challenges that idea that only startups can do this, that incumbents are stuck.
It totally challenges that lore. Incumbents can, and often do, create blue oceans right from within their own red oceans. They do it by reevaluating what they offer through the lens of buyer value. Often it involves eliminating or reducing factors the industry takes for granted,
Things everyone competes on, but maybe customers don't care that much about.
Right, and then raising or creating totally new elements that offer unique value.
But don't established companies worry about, cannibalizing their existing business?
They do, and that fear can be paralyzing. But sometimes that perceived threat is exaggerated, and it stops them from seeing these internal opportunities.
That distinction makes a lot of sense. And it kind of leads us into another classic issue, doesn't it? The innovator's dilemma.
Ah, yes, Clayton Christensen's seminal work.
It explains why even really good management, like objectively excellent management, can sometimes lead a company to fail when faced with disruptive technologies.
It sounds completely backwards, right? How can good management be bad?
Exactly.
Well, if we connect this to the bigger picture, the dilemma highlights a critical truth: the pace of technological progress. It often outstrips what the market actually needs or can absorb.
Okay, unpack that a bit.
Think about it. Well-managed companies, they're diligent, they listen closely to their existing most profitable customers,
Makes sense.
and they invest aggressively in what those customers say they want: better performance, more features, etc.
Right. Keep making the product better.
But eventually, those improvements become more than the average customer can really use or is willing to pay a premium for. They overshoot the market needs.
So they're making these amazing products.
Yep. But they become too complex, too expensive for a chunk of the market. And that relentless pursuit of the high end, paradoxically, leaves them incredibly vulnerable.
Vulnerable to what?
To disruptors. These newcomers often enter with a simpler, cheaper product. It might not perform as well initially on the traditional metrics.
But it's good enough for a different set of customers.
Exactly. It might serve a new, overlooked market segment, or maybe a part of the mainstream market that felt overserved and undervalued by the incumbents' fancy features.
This is where that distinction between sustaining and disruptive technologies becomes so important, isn't it?
Absolutely crucial. Sustaining technologies, that's what established companies are great at. Improving existing products in ways current customers already value. Faster chips, bigger screens.
Or bells and whistles.
Right. But disruptive technologies are different. They often underperform initially on those key metrics.
Lower resolution, maybe slower speed at first.
Yeah, but they possess other attributes. They might be cheaper, smaller, simpler, way more convenient.
And those attributes appeal to new or different markets.
Precisely. They effectively open up entirely new markets because they solve a different problem for customers who couldn't access or afford the mainstream product before.
Then they get better.
Then, with experience and focused investment, these disruptive technologies often improve rapidly. They climb up market, eventually become competitive in the mainstream.
And can completely displace the old leaders who are focused on their demanding high-end customers.
It's a powerful cycle, almost inevitable in many industries. We see it again and again.
But even knowing all this, even when executives read these books and understand the concepts,
They still struggle, yeah.
our sources point to things like strategic impediments and these deeply ingrained mental models as huge roadblocks, often invisible ones.
Red Ocean Traps talks about this. Companies pour tons of money into trying to create new market spaces.
But very few actually succeed in cultivating them. Why? What's blocking them?
Well, this raises that really important question. How do you actually break free from those cognitive algorithms holding you back?
Cognitive algorithms, like mental programming.
Kind of. These mental models are deeply ingrained assumptions about how the world works, how customers behave, what value even means.
And they're often subconscious.
Critically, yes. They operate below our conscious awareness, like hidden scripts dictating our choices, our behaviors, even how we interpret data.
So even if a leader intellectually sees the value in a blue ocean,
These hidden assumptions, these unconscious biases, can subtly sabotage every effort to actually get there.
it's like trying to drive somewhere new, but your internal GPS keeps rerouting you back to the old familiar highway.
That's a great analogy. Even if that highway is a congested, competitive red ocean, the challenge isn't just seeing the new path, it's overriding that deep programming that tells you the old way is the only way.
Let's make this more concrete. Look at some examples of these strategic shifts. Netflix comes to mind. Their move into exclusive content.
Oh, absolutely. A classic example discussed in Seven Powers. Initially, Netflix had this huge, substantial scale advantage, right, with their massive library of licensed stuff.
They were the dominant streamer.
But the game changed. As streaming got bigger, the content owners, the studios, the networks realized They held the keys to the kingdom.
They realized the value of their own libraries.
And they started to bargain hard for an outsized share of those returns. They didn't just roll over anymore.
And they used competitors against Netflix.
Yep, using rivals like Amazon as stalking horses. They'd entertain bids from others just to drive up the price Netflix had to pay.
Ouch.
It's a perfect illustration of how competitive dynamics are explicitly relative. It's not just about you, it's about you versus everyone else, potential rivals included.
So good strategy means assessing power relative to each competitor.
Exactly. And when those content deals shifted from, say, a predictable fixed price to a variable cost driven by bidding wars, the power dynamics just flipped.
Which forced Netflix's hand.
It forced them to completely redefine their strategy. They had to pivot from being primarily a content distributor to becoming a major content owner and creator, investing billions in originals.
They had to build their own moat.
They had to, or risk being squeezed out of the very market they created.
Okay, another example. Starbucks. Howard Schultz talks about this, and pour your heart into it.
Right, a company that masterfully cultivated its brand.
And initially, they deliberately stayed out of grocery stores.
Yeah, because, let's be honest, the coffee typically found there back then was not great.
Inferior quality. Didn't match their premium image.
Didn't align with the whole third-place experience they were meticulously crafting in their stores. It would have diluted the brand.
But then they changed their mind.
But only after the Starbucks brand was firmly established at retail. Once people knew Starbucks meant high-quality coffee in that unique store experience.
They had built trust, brand validation.
Crucial assets. Only then, with that strong foundation, could they strategically experiment, putting premium whole bean coffee into supermarkets.
Expanding their reach without hurting the core brand.
Exactly. It's a classic case. Build a strong core, validate your value proposition meticulously, then venture into potentially riskier channels.
They didn't just jump in. They waited until their brand power could essentially transform that grocery aisle.
Turning what was a red ocean of generic coffee into a new blue ocean for premium coffee in the grocery store, capturing a whole new customer segment.
The indispensable role of human behavior and leadership.
Okay, so we've talked about grand strategies, market forces, but beyond all that, our sources consistently hammer home the critical role of individuals.
The human element. Absolutely essential, yet often underestimated.
Yeah, whether it's leaders at the top, employees on the front lines, even us as customers making choices. Human behavior is kind of the engine, right?
Or sometimes the brake. It can absolutely derail the best laid plans.
It's fundamentally about how we lead, how we decide things, how we interact.
It's the so-called soft stuff that ironically often drives the hardest results. You ignore the human element at your peril.
Let's start with leadership and this idea of ownership. Extreme ownership. The book by those Navy SEALs.
Jocko Willink and Leif Babin. Powerful stuff.
Really powerful insights. They observed that the operators who had the least ownership of the planning...
The ones who were just told what to do.
Yeah. They suffered the worst combat fatigue. They hesitated more, questioned the risks more deeply.
Whereas those who had some ownership, even just a little bit of input into the plan,
remained remarkably more focused, more positive, more resilient.
And this isn't just about soldiers, is it?
No way. It applies everywhere. Corporate boardrooms, small teams. When people feel a genuine stake in something,
their commitment just skyrockets. Performance follows.
And this idea of ownership, it extends right into personal responsibility, doesn't it? The essence of leadership.
It really does.
Yeah.
The 21 irrefutable laws of leadership makes this point well. A leader's credibility, their legitimacy. It starts with their own personal success, their competence.
You have to be able to do it yourself first.
Right. But it truly blossoms, it culminates in their ability to help others achieve success.
And that's not passive.
Not at all. It demands active initiative, sacrifice, and maturity. Leaders who empower ownership, who delegate real authority and accountability, not just tasks.
They foster more than just better performance.
Oh, yeah. Greater resilience, more innovation, deeper engagement, because people are just inherently more committed to something they help build and feel responsible for.
It shifts things from mere compliance
to genuine commitment. Big difference.
Okay, let's talk decision-making, because we're often not as rational as we think we are.
Definitely not. Our minds play tricks on us.
Originals highlights that amazing research by Tversky and Kahneman, prospect theory,
showing how you can dramatically shift risk preferences just by changing a few words, emphasizing losses versus gains.
Right. The classic example, a treatment with a 90% survival rate Sounds way better than one with a 10% mortality rate,
Even though they're statistically identical, it's all about the framing.
which has huge implications for motivating people.
Huge. It underpins so much of behavioral economics. It forces you to ask, how do you effectively motivate change?
Do you focus on the upsides of changing?
Or do you emphasize the costs, the risks of not changing?
And the answer is, it depends.
It depends entirely on how risky the change feels to the person you're talking to. If it seems relatively safe, emphasizing potential gains usually works better.
But if it feels inherently risky,
Then, highlighting the potential losses of staying put, of inaction, can be a much stronger motivator. Loss aversion is powerful.
we think we're logical, but these biases are always humming away in the background.
Always. And even subtle things like nudges can have a big impact, as the book Nudge explores.
Like what?
Well, simple things like the idea that everyone believes in redemption, which makes us give second chances, maybe more than we should based on past behavior.
Or our tendency towards over-optimism.
Yes, consistently underestimating how long tasks will take or how much they'll cost, even when we've failed before. We just think, this time will be different.
And sometimes the most effective feedback, the kind that really shifts behavior, is the uncomfortable kind.
Direct feedback. Yeah.
Like the concept of radical candor. Performance reviews, if they're done right.
Which is a big if.
True, but if done well, they can clarify miscommunications or behavioral issues in a way that casual, impromptu feedback often doesn't.
It forces a confrontation with reality.
Kind of. A direct, even low rating on something specific, like negativity, when delivered with care and the intent to help. It can make someone truly understand their impact.
Something they might have brushed off or rationalized away before.
Exactly. It's that moment of truth that might get sidestepped in softer conversations.
And that connects to what Andy Grove wrote about in High Output Management, actually. He called performance reviews the single most important form of task-relevant feedback
High praise.
because they have immense power to influence performance, good or bad, for a long time. It's a high-leverage activity for any manager.
It's not just about judging. It's about clarifying, aligning, developing.
Building accountability, absolutely.
Okay, shifting to organizational culture and leadership styles, Elon Musk is... he's a character.
That's one way to put it. The biography Elon Musk paints a fascinating picture.
Engineers found working for him both torturous and magical? What does that even mean?
Well, consider this. He might flat out deny a request for a crucial $200,000 piece of machinery, citing cost.
Okay, seems frugal.
But then comfortably spend a similar amount on making the factory floor look shiny and impressive. Aesthetics matter to him, sometimes more than proven tools.
That's unconventional.
Or the story about refusing to pave a path between buildings, making engineers haul multi-million-dollar rockets over dirt using wooden planks.
Like ancient Egyptians, the book says.
It shows this incredibly unconventional, sometimes brutal, but undeniably effective drive, stripping away everything not essential to hit these audacious goals.
It definitely gets results, but at what cost sometimes?
And that brings us right to a crucial tension in leadership, doesn't it? Which is the tension between creating a trusting, supportive, relaxed environment, psychological safety, and having that relentless, driven attitude that's needed to get things done under crazy pressure.
We saw that with Steve Jobs, too, right? Based on his biography.
Absolutely. Jobs, much like Musk, had this incredibly demanding, sometimes abrasive style. It was tough on people.
But undeniably effective at pushing boundaries, demanding excellence, achieving the seemingly impossible.
So the challenge for any leader is finding that balance. How do you maintain sky-high expectations without burning out your team or crushing morale?
It's a tightrope walk.
A real tightrope walk between inspiration and intimidation. Different people need different things.
And then there's a blunt reality of some environments, that line from Liar's Poker about loyalty at Salomon Brothers.
Oh, the Cocker Spaniel line. Classic.
Yeah, a hugely successful trader quits for way more money, and when management talks about loyalty, he just says,
You want loyalty? Hire a Cocker Spaniel.
It just speaks volumes, doesn't it? About the purely transactional nature of that world, especially back then.
Totally. In those high stakes, eat what you kill environments, individual performance and big money often trumped everything else. Loyalty was a quaint notion.
A brutal meritocracy. Only the top dogs mattered.
Navigating the complexities of markets and investing.
Okay, let's pivot now to the world of finance. Our sources really peel back the layers on how markets actually work.
And it's often deeply counterintuitive, isn't it?
Very. And we see how investors try, keyword try, to navigate all the inherent risks, many of which are hidden.
It's a place where elegant theories constantly collide with the messy reality of human behavior and, frankly, randomness.
Let's start with the big one, market efficiency.
The efficient markets theory, or EMT, famously discussed in Liar's Poker.
The core idea being that all available public information is already baked into share prices.
Right, making them essentially fairly valued at all times, if the theory holds true.
Then trying to beat the market is pointless.
Pretty much. The implication was that stockbrokers, analysts, all their research, they wouldn't consistently do any better than, say, a monkey drawing a name from a hat.
Because any edge from information is instantly competed away.
That's the theory. All known information is already priced in.
But this raises a huge question, doesn't it? If markets are truly efficient, how did people like Michael Milken make such insane profits?
Exactly. Liar's Poker argues that Milken fundamentally rejected EMT. He looked at the market and saw
Inefficiency.
gross inefficiency. He believed the market was terrible at valuing everything from the land a company owns to the pension fund it creates.
So he looked where others weren't looking.
Specifically, he looked at junk bonds debt from companies with lower credit ratings that Wall Street had basically ignored or dismissed as too risky.
But he saw something different.
He saw undervalued assets, not junk. He believed the risk was mispriced. This gap between the market's perception and what he saw as intrinsic value created.
Huge opportunity, just lying under the dirt.
Precisely. Waiting for someone with a different perspective, maybe better tools, or just the guts to act on an unconventional insight.
So the academic theory of perfect information didn't quite match reality.
It showed that opportunities can exist for those who find inefficiencies, who have unique insights, or who are willing to be contrarian. Milken essentially created a whole new, highly profitable market by seeing value where others only saw risk. A financial blue ocean, if you will.
Okay, beyond the theories, there's that primal human element, risk, the gambling instinct.
The intelligent investor hits this nail on the head. It reminds us the gambling instinct is part of human nature.
Hardwired into us.
Yeah, trying to completely suppress it is futile for most people. It's just too strong. But the book stresses it absolutely must be confined and restrained. We have to be careful not to confuse pure speculation, just betting on price moves, with genuine investment.
Which is based on analysis.
Based on diligent analysis of underlying value, long-term prospects. Knowing the difference between a calculated risk and just a blind gamble driven by emotion or hype is crucial.
Absolutely critical for financial health.
And connecting this to the bigger picture, the most important thing illuminated adds another layer of nuance here.
Which is?
Just because an investment works out and you make money doesn't automatically mean it wasn't risky when you made it. You might have just gotten lucky.
Right. Outcome doesn't define the initial risk.
And conversely, if you lose money, it doesn't automatically mean the investment was inherently super risky. Sometimes just bad luck or unforeseen events happen.
So the real test of skill isn't just making money when things go your way.
No. The true test is how investors perform consistently, especially in environments where their style isn't favored. Can they protect capital in a downturn? Can they still participate meaningfully in an upturn?
It's about having a robust process, repeatable results, not just catching a lucky break.
Exactly. Foresight and discipline, not just good fortune.
And we see the raw power of human psychology, especially things like optimism bias, in big market events. Think about the 1929 crash.
A harrowing example. A random walk down Wall Street recounts it vividly.
Even as the market was collapsing, you had figures like Irving Fisher dismissing the decline as just a shaking out of the lunatic fringe.
Clinging to the belief that prices hadn't caught up with real value and were bound to go higher. Total denial.
He even, bizarrely, attributed positive economic effects to prohibition, saying it made workers more productive.
It's almost painful to read. A stark reminder of how deeply we can cling to our beliefs and rationalize away disaster, especially when we're heavily invested financially and emotionally.
That optimism bias, or maybe confirmation bias, is incredibly powerful and dangerous.
It really demonstrates how easily we can ignore red flags and invent justifications when we desperately want a certain outcome, a trap even for smart, experienced people.
Okay, let's talk about monetary theory for a moment and how financial instruments themselves evolve. The plumbing of the system.
Keynes' general theory introduces some foundational concepts here, like liquidity preference.
Which is basically the desire to hold cash for security.
Right. out of fear or uncertainty about the future value of other assets, wanting that safety of cash,
And alongside that is the speculative motive.
which is holding cash not for safety but hoping to profit later by timing the market, believing, better than the market what the future will bring forth.
And Keynes saw a tension here, right, regarding organized markets.
A real dilemma. On one hand, liquid markets where you can buy and sell easily reduce the need for precautionary cash holding. You can always sell assets if you need funds.
Makes sense.
But paradoxically, by making trading so easy and constant, these same markets tend to increase speculative activity. They encourage short-term betting over long-term investment.
So how do these abstract ideas play out in the real world?
Well, think about major policy shifts. Business Adventures discusses Britain leaving the gold standard in 1931 and the U.S. following in 1933.
A huge deal at the time.
Massive. The gold standard had pegged currencies to gold, providing stability but restricting governments' ability to manage their economies.
So abandoning it
Led to chaos, currency devaluations. It allowed governments to print more money, but it shattered the old financial order. It shows the immense, often destabilizing impact of fundamental monetary policy shifts. The rules of the game changed overnight.
And speaking of changing the game, we also see constant innovation, maybe sometimes over-innovation in financial products themselves.
Oh yeah, Liar's Poker gives that incredible account of how home mortgages got sliced and diced.
Into CMOs, IOs, POs, alphabet soup.
Exactly. Imagine taking a simple mortgage, one stream of payments, and carving it up into loads of different pieces.
Like interest-only strips.
Yeah.
Just the interest payments.
Right. Or principal-only strips, POs.
Yeah.
Just the principal repayments. Then Wall Street took these pieces and repackaged them into complex new securities called CMOs, collateralized mortgage obligations,
Creating things that didn't exist before with different risk profiles.
creating home mortgages that could never exist in the real world, as the book says. This financial engineering, it completely transformed mortgage trading.
From a corner shop to supermarket.
A supermarket overflowing with complex new products, it dramatically increased the volume and complexity of the market. And crucially, it brought in tons of new shoppers, institutional investors who could now play in the mortgage market in ways they couldn't before.
Which fueled growth, but also risk.
It fueled massive growth, particularly for savings and loans,
Yeah.
allowing them to expand beyond old limits. But yes, it also created unforeseen systemic risks that blew up spectacularly later on. A real testament to financial ingenuity, and sometimes its dangerous side effects.
Outro. Okay, so we've covered a lot of ground. Blue oceans, innovators' dilemmas, leadership styles, cognitive biases, market mechanics. What does this all mean for you, our listener?
As you navigate your own world professionally or personally.
Yeah. What's the big takeaway from weaving all these threads together?
Well, if we can't all back, I think the clearest message is the absolute importance of having a multifaceted perspective.
Not looking at things in isolation.
Exactly. Success, whether it's in a giant corporation, your personal finances, or even just achieving a personal goal, it rarely springs from just one single factor or some simple fix.
It's about understanding those complex interactions.
Deeply understanding them, challenging your own assumptions constantly, and critically learning not just from the wins, but maybe even more from the setbacks and failures.
Which requires humility.
Definitely. The world demands what Ray Dalio in Principles calls intellectual humility. That willingness to really fight to figure out what's true, even if it means taking a hard, objective look at yourself and your most cherished beliefs.
Being open to being wrong.
Because that's honestly the fastest way to learn and adapt.
And the stories and insights we've pulled today, they really highlight some recurring themes, don't they? Adaptation.
Strategic foresight.
And a really keen, empathetic understanding of human nature. Those seem vital.
Absolutely. It boils down to being observant, staying flexible when things inevitably change.
And recognizing that even in the most established industries or your most comfortable routines, the game can always change.
Always. And the ones who anticipate that, who adapt, they're the ones who tend to thrive.
So maybe a final question for you, the listener, to ponder.
Yeah, something to chew on after this.
In your own world, your work, your life, where might your own mental models, those hidden assumptions we talked about,
Where might they be unknowingly trapping you, keeping you stuck in a sort of red ocean of conventional thinking or self-imposed limits?
and flipping that, what small, maybe seemingly insignificant change?
A new perspective, an overlooked piece of information.
What might open up a blue ocean of opportunity for you? Or reveal a hidden truth that could fundamentally shift your approach?
Worth thinking about. Where are those blind spots, and what could they unlock if you saw past them?
Thank you so much for joining us on this deep dive.
It's been fascinating connecting these dots.
Until next time, keep digging into the complexities. Keep questioning the assumptions you encounter.
And most importantly, keep learning.